Banks and some companies are turning in their results for the first quarter of the year and, of course, for 2015 full year. First Bank yesterday turned in its result for 2015, showing a year-on-year gross earning growth of 4.9% to about 505.2 billion naira. The report issued before the market close, however, reveals pre-tax profit slump of 77.1% to 21.5%. FBN Holdings profit after tax was also reported at a whopping decline of 82% to 15.1 billion naira from 84 billion naira recorded for the full year 2014. And the group is actually proposing a dividend of 15 kobo per share. But let's talk to Ebong. He's the group executive, Treasury and Financial Institutions at First Bank of Nigeria Limited. A good morning to you, Mr. Ebong. Thank you for coming on this morning.
Good morning, Harriet. Thank you for having me.
So we're looking at these numbers, and it comes across that investors are not particularly happy about it. Let's put some flesh to it. Facts behind the figures, if you'd like.
Okay, thank you, Harriet. As we've seen, in 2015 was a tough and challenging year for the institution. Clearly, throughout its history, this has been one of the most challenging periods on account of the back of the generally weak macroeconomic environment, which has culminated in us having to take some significant credit impairments in the course of the year, and that has fed through into the results. That said, I think what is key is that the underlying business of the bank and the banking group remains strong, and we continue to see our ways in dealing with our issues and moving forward and to regain our top spot in the industry.
Comment on this, if you will. Impairment charges, you already mentioned it was mainly responsible for the decline we noticed in profit. What segment of the group's loans did you record the most impairments?
Well, given the size of the institution and when you consider that the bank has historically always been in the forefront of leading credit expansion across the economy, it's been largely broad-based. In particular, we did witness some weakness in our oil and gas portfolio. Predominantly the downstream as well as some upstream assets, given the foray of Nigerian banks into supporting the government's push for the indigenization of the upstream oil and gas sector. So that was a big impact there. But it's also largely been broad-based on account of the downturn in the macro environment as well.
So what's your outlook on the quality of risk assets that the group owns?
Well, the focus for us going forward is largely threefold. We're looking at a significant review of our credit risk appetite. We're seeking active remediation of some of the accounts in question. We do expect to remediate a number of these issues through the course of 2016. Aside from that, we're focusing on working on our operational efficiency, driving our cost dynamics, and you would see that we did record some reduction in our cost base. Our cost-to-income ratio declined at the holding company level to 61%. So we are moving in the right direction in that regard. And further to that, we will be focusing on driving business in the coming year. I mean, clearly, notwithstanding the weaker macro environment, the economy is still growing. So we will be a part of that and drive our growth along those levers.
So should investors be expecting more cost cutting?
Well, I wouldn't say cost cutting. I would rather focus on more operational efficiency. We have been criticized in the past relative to our peers. We have demonstrated in FY 2015 that we're driving in the right direction. We expect to continue to push on those efforts to reduce the cost to serve and drive down increase our efficiency and drive down our cost-to-income ratio significantly more beyond where we are today.
Was the group immune to all the challenges that was experienced by your other peers in terms of forex, dollar liquidity affecting your operations?
Well, I mean, that's a broad macro situation. I mean, clearly being part of the market, it did affect us, and it has had an impact on our earnings to the extent that our business activities have reduced around our import and trade finance activity. That said, being a large tier 1 bank, we have sufficient foreign currency liquidity to meet our obligations. We still have access to foreign correspondent banking lines and funding to sustain business. It has been a challenge on account of the policy direction, but we believe we will weather it and work our way out of it.
So this is we've just gone past the first quarter of 2016. What measures or strategies, if you'd like to put it that way, will give us a peek into what we should be expecting from the group in terms of taking the bank to be and making the bank to be more competitive in this slowing economy?
Well, I alluded to some of the things we were looking at earlier, but I will give you a bit of flesh here. First of all, like I said, we're restating our risk appetite. So we're overhauling our credit risk management policies, procedures, and risk architecture, right? We're focusing aggressively on remediation of our problematic accounts. But beyond that, moving forward, I think the key focus for us is driving our operational efficiency. Over the years, we've invested in building out our network. We have the largest footprint across the country. We have the largest number of channels. We believe it's now time for us to drive the monetization of these channels, and really that lends itself to our retail footprint. So we're actively focusing on driving what we call digital banking, which is the aggressive use of our channels and touch points to drive transactional-based revenue. We've got the largest number of cards out in issue, where more than half of transaction volume on the switching network. So we believe if we continue to push the use of channels, the use of these things, it will be a significant drive and contribution to our revenues and outlook going forward.
Well, Ebong, thank you so much for coming on the program this morning and shedding more light and giving us the facts behind the figures.
Thank you very much, Harriet.